So hi guys, this is going to be my first video with related to CPA subject. So I'm making this series of video with related to FAR subject, and this first video we are talking about full set of financial statement, which is as per US GAAP, what is the meaning of balance sheet, what is the meaning of income statement, what is called comprehensive income, cash flow, owner's equity. So in US GAAP, as per US GAAP financial statement, in financial statement basically it's include balance sheet, income statement, comprehensive income, and cash flow, and then owner's equity. So this all consist, and yeah, as well as this notes of accounts also. So including all this is called the full set of financial statement. So the first is statement of financial position, that is called balance sheet. So hope this pointer I'm just making so for your easy understand. So statement of financial position means the balance sheet. In general term, we used to call them the balance sheet. It is like basically financial risk, and so basically it's give you the information about the financial risk, information like how good you are in the short term liquidity, and how good you are in the long-term solvency. And by checking the balance sheet, we can understand whether our liquidity are better, or our solvency is good, or whether we have any potential growth or not. So we will discuss in detail about this balance sheet in coming in just some time. But as of now, you just understand like this financial position, that is called balance sheet, is give you the financial risk related information. It will give you the idea about how the company good about the short term liquidity. So that this is one thing, and the second is the statement of earning, that is called income statement. So it basically give you the information about the performance of the entity, whether you are gaining, whether the entity, the company are making profit or not, or how good with related to operating risk, operating profit, with related to all this information we can know about by checking the income statement. The next thing is about the statement of comprehensive income. This is the US. So comprehensive income we will discuss more in detail in coming video. As of now, you just understand about one thing, like comprehensive income include net income as per the income statement, plus other comprehensive income. Other comprehensive income are those income which are generally not been part of income statement, that is statement of earning, and that is directly come under the comprehensive income. Then we have this statement of cash flow. So cash flow is basically kind of the statement which basically give us the information how we are generating the cash. So let's suppose you have the 50,000 of cash in the beginning of the year, and by end of the year you have like 100k of the 100k of the cash. So how you basically achieve that 50k, whether you have taken loan, whether you have issued additional share, or that or how basically you got from 50k to 200k, whether you generated that 50k additional cash from business operations. So that cash flow statement is very important to understand how entity, how the company are actually making the cash. So the next is the statement of owner's equity. So statement of owner's equity is also a very important things to understand how owner's equity are actually changing, like does the company are issuing more share. So that will also not a good sign to making more partner into the company, or or does the company have more retained earning, which is a good sign, like company are generating revenue, so basically, to have the more retained earning will have a positive impact to the investor. They understand like company have a very good potential, but once they have the understanding about the statement of owners equity. So this is the one thing about to understand about what is the full set of financial statement. Let's move to the next slide. So, so this is the balance sheet. So balance sheet, one thing you have to understand, like balance sheet, we always present as a cumulative and on a particular date basis. So so whatever information you are seeing in the balance sheet, either assets or liability, all the balances are basically on a cumulative basis. So let's suppose you have purchased one assets in 5 year back in 2020. So whatever assets value you have purchased in 2020, let's suppose you have purchased that assets for 100K. So in balance sheet, that assets value will always be the 100K. So this how the balance sheet is represented. And whatever the depreciation you have like charged to against that assets, that you have to show separately, but the value of the assets will remain the same. So one side of this, the negative side of this is, it will the balance sheet generally not give you the correct information, because we are showing the balance sheet on a historical price. We are not presenting our balance sheet as per the current market or the fair market value. So balance sheet so this is just a a negative impression, negative things for the balance sheet, like we are presenting our balance sheet on a historical cost rather than on a market price. So hope you understand what I'm trying to say here. This is just a part of the assets. Assets is basically categorized between current assets and non-current assets, and liability is also presented in current and non-current. So one thing you have to understand, by checking the current assets and current liability, you can understand the how good company into the liquidity. So the more current assets will have a positive impact to the investor, like the company are more good with related to the liquidity. Other negative side, to have a more current assets, like the other part or other things you can say, like company are not fully utilizing their potential. Like once we have the more current assets, we can say like company are just parking their cash, or they are not investing that cash, or they are not fully utilizing that cash by keeping that cash into the current assets. So and the other part, you can say like company have more cash, so company will pay their liability in a timely basis. So you have to manage your liquidity in a such a way, it should not be so high, it should not be so low. So this is one thing. And the next is the debt and equity ratio. By checking the balance sheet, you can understand how good you are with related to your debt and equity ratio. Let's move to the next slide. The next slide is talking about this is also the part of the balance sheet. In that slide, we as per US GAAP, the balance sheet are as I mentioned you, this is the assets part only, but this is related to more toward non-current assets. So we have land, building, equipment, goodwill, patent, pension, other post-retirement benefit assets, deferred income tax assets, etc. And on a liability side we have the capital assets, preferred stock and common stock. So preferred stock is basically a kind of assets which generally pay before the common stock, and another part is the paid in capital excess of par, which is also called the APIC. And then we have the retain earning. The more retain earning we have, is basically the more the cash generated entity it is. And the last part is the treasury stock. So treasury stock is basically a kind of stock which company basically purchasing their own stock, is categorized under the treasury stock. So this is the balance sheet of the part. Let's move to the next slide. This is also with the part of the balance sheet only, where we are showing as a remaining part of the balance sheet, basically goodwill, patent, and pension, other post-retirement benefit, deferred income tax assets. And the other part of balance liability side is common stock, paid in capital in excess of return earning, etc. So this is all the total of the balance sheet item. Okay, so now let's talk about the purpose and usage of the balance sheet. So the purpose and the usage of the balance sheet is basically, the balance sheet is give you the short-term and long-term financial risk related information. So if I'm talking about short-term and long-term financial risk related information, so it means let's suppose you have by checking the balance sheet information, we can understand about the current assets and current liability. So if we have more current liability rather than the current assets, it means like we are not good uh, uh, like so basically our company are not in a good position to pay the liability. So we should always have a more current assets than current liability, so that we can easily pay all our current liability on a timely basis. And the next part is the show type of assets, liability, current versus long term, tangible versus intangible. So what type of current so basically the more in term of assets category, if we have more current assets uh, rather than non-current assets, so it is a good for us actually. And the next is basically we used to evaluate liquidity and long-term solvency. So, by checking the balance sheet, we can calculate current ratio, our quick ratio, degree of financial leverage, etc. These all things we will discuss in detail in coming video. What is current ratio? What is quick ratio? What is the degree of financial leverage, etc. So this is the important thing. I would say the balance sheet formula: assets is equal to liability plus equity. So you have already studied like liability is always paid before the equity. So if I reduce my assets minus liability, then the remaining part will always be my equity. So whatever assets I have, firstly I have to pay out my liability, and the whatever remaining part will have, then that is called the remaining part we called as a equity. Coming to the next part, this is related to component of the balance sheet, which is called assets. Assets, in general term, we can say probable future economic benefit. So, whatever expenditure we are making today, if any potential benefit are going to derive from that expenditure more than 1 year, that expenditure we can categorize as a assets. For example, some of your company employees are actually working on one of the project to make one kind of software, and that software are going to be deployed within the organization, and that software is basically gives the benefit to the company for next 5 years. Then the whatever expenditure we are making to pay the salary for our employees, who all are developing that software, then then that cost of the software we can categorize as a assets. So this is general meaning of the assets. So hope you understand. uh, Now coming to the current assets, cash uh, and assets expected to convert to cash within 1 year. So the meaning of current assets is basically whatever whatever amount, if we are able to convert within 1 year into the cash, we can categorize as a current assets. Example is basically cash, AR, prepaid inventory, short-term investment. All these are kind of things which can be converted into cash within 1 year. So whatever receivables you have, we are expecting within 1 year we can receive all our outstanding. We can categorize as a current assets. Coming to the next stage, investment and fund, non-current, not directly used in the operation. So the kind of investment, let's suppose you have investment some in another company. So that is that things you can categorize as an investment, which is basically not a current assets. Then you have some property, plant, equipment. Example, you have purchased any kind of property, any plant to manufacture something within your organization. So that is called the property, PP and E, property, plant and equipment. The next is the intangible, no physical substance, long-term live used in operation. So basically it is called the patent, copyright, trademark. So and the another example that I have give you about the software related. So this all called the intangible. The next is the other non-current assets. So the remaining part we can categorize under the non-current assets. Let's move to the next slide. So the component of the balance sheet is basically have the liability. First claim on the assets, as I mentioned just before some time back, like whatever assets you have, whatever if any liability are there. So okay, so next part is the current liability, obligation to be satisfied with current assets. Long-term liability is basically like obligation to be satisfied beyond 1 year. So current liability means we can pay that liability within 1 year. We can categorize as a current liability. If the obligation we have like some kind of interest payment, some kind of loan which generally have more than 1 year of liability, then that kind of liability we can categorize as a long-term liability. Then we have the equity, preferred stock, common stock, APIC, additional paid-in capital. So the preferred stock is basically the second claim. The first claim is liability. The second claim is the preferred stock, and common stock is basically the last one who can claim anything in case of liquidity of the entity. Retained earning, as you understand, the remaining part of the balance of the P&L, whatever amount we are remain are basically categorized under the retained earning. Then we have accumulated other comprehensive income. This we will discuss in detail about the comprehensive income, is also categorized under the retained earning only. Then we have the treasury stock, as I mentioned, whatever kind of share which company purchase their own share is basically categorized under the treasury stock. We have this limitation of balance sheet. This is very important part. I'm not sure whether you can able to understand as of now or not, but balance sheet is always not give you the correct information, because the balance sheet we prepare as per the book value, as per the historical cost. Balance sheet is generally not give you the market value. Let's suppose you have purchased one building 5 year back. Now that building valuation is 5 times of the price that you have purchased, but in your balance sheet it will always remain in your book value, in your historical cost. So as it is mentioned here, many assets and equity issuance are measured at the historical cost. Example, a depreciated building on the balance sheet may have zero value. For example, one building you have purchased in 2020, and within 5 years, by taking the depreciable method, you have depreciated all your building, but that building value are still there. So even not there, the building value is basically increased by 5 times. So what I'm trying to say here is basically, balance sheet is not give you the correct information. So this is all the limitation of the balance sheet. Some measurement are subjective, making comparison difficult. Example, valuation method for inventory between LIFO and FIFO, and straight line versus accelerated method. So we have a different kind of method for inventory, LIFO versus FIFO, that can have a different kind of calculation method and working, which always give you the wrong information, wrong picture about calculation, your estimation, etc. Then the last point is related to estimate may be used for the preparation of the balance sheet. So we always use the estimate for our balance sheet. For example, we use 5 year of depreciation method or 10 year of depreciation method, that generally are not been applicable for fair market value. We just use for our book value. So this is as of now for this video. Hope this is my first video, and my voice not very much clear as of now, and hopefully in my next or coming video I will talk more in a better voice. Due to cold, I'm not able to speak clearly. And thank you if you have watched this full video. Thank you so much. And if you have, and if you like this video, even 1% or 2% or 5%, just like this video and subscribe my channel. I hope in coming video I will able to explain more clearly in more detailed way. Thank you for watching this full video as of now. Thank you so much.